don't leave yourself exposed to unlimited liability and even tax audit risk. Don't make these mistakes when incorporating, and don't pay too much in tax or lose flexibility when choosing what type of corporation to be. There's so many mistakes people make when it comes to setting up a corporation. Well, the first one is they don't incorporate. The second is they don't use an attorney. Or third, they don't customize their operating agreements. Or fourth, they do a thing called commingling, which creates the alter ego. And I'm going to talk about how you can avoid commingling. When does it make sense to be a solo LLC and when doesn't it? If you do it wrong, you're going to pay too much in tax and you're not going to use it properly. When does it make sense to be an S corporation? And it's especially problematic when you do that wrong because it's so inflexible. And when should you use a C Corp? And when can a C Corp save you $10 million when you sell your business? And ultimately, don't choose the wrong state. That's going to be a major problem. Look, here's the ream. I feel like attorneys, they need a publicist. Maybe some better marketing. Maybe attorneys just need new branding. Think about it. Vampires, sharks, ambulance chasers, hired guns, suits, even snake. I think attorneys should hire whoever's behind this Kale movement, Kale. Like, who in the hell is Kale's publicist? Kale. It used to be that inedible decoration you set food on at the Pizza Hut salad bar. Like, no one actually ate it. Now it's a superfood that's in everything. Like everything that can mask its taste, right? Like salads, chips, smoothies. They literally stick it anywhere they can hide the flavor of it because it tastes like the garden's anus. It's not just kale. Everything has branding these days. Like every product I buy from the grocery store has an origin story now. It's always about some everyday nice person who founded the company. Another family brings this fresh, wonderful taste to you at twice the price. Here at the organic, natural, pure, blissful potato company, our happy chips are made only from the world's wokest potatoes, baked in exotic coconut oils, and sent with the blessing of love and health by in-house shaman Steve. Well, screw you, Steve. I'll just take my cereal box with the cartoons and corn syrup and save the difference. All right, back to the matter at hand. Whatever reason you don't have the proper legal structure, it's costing you risk, tax, even peace of mind. Here are the main issues to avoid when it comes to setting up the right corporate structure. And important note here, I'm not an attorney, so please hire one, or you can engage my firm where we have brilliant attorneys support you in implementing what we're talking about here. First issue is when people don't incorporate when they're in business. You have unlimited liability if you don't incorporate. It all passes on to you personally. And when you're not incorporated, there's a 400% higher chance of being audited. Why? Because people file income under their Schedule C on personal tax returns when they don't incorporate. There's a greater perception of misreporting income or expenses. Corporations and LLCs have a more formal tax structure, and that'll reduce your audit risk. If you don't incorporate, it's also going to limit your tax advantages. I'm going to cover that in a lot more detail here in a bit. And when you don't incorporate, there's zero legal protection of the business name. All right, the second issue, and this is for you misers out there. I'm a recovering miser. But if you're not going to use an attorney, you're missing out on so much of the proper opportunity here. Because if you have an attorney, they can think through things like your operating agreement, and they can consider what type of entity makes sense from a tax purpose. But most importantly, what happens if you're sued? Who's going to defend you? Like, yeah, there's ChatGPT that can kind of help you put together an LLC, or you can print one off the internet. But the reality is it really going to do what it was meant to do? Does it have the right provisions in there? We'll go into more detail here in a minute. Because the third issue is when people don't customize their operating agreement. So your operating agreement is a part where you get to talk about your preferences. What happens if things go differently than planned? This provides a tailored framework for how the company will actually operate. If it's generic, if it's a boilerplate operating agreement, it's not going to address the specific needs and goals of your business. And that potentially is going to lead to disputes, inefficiencies, or even legal vulnerabilities. So let's go through why you would want to customize an operating agreement and what parts are important. What it can allow you to do is clearly define roles and responsibilities. It can help you establish, the decision-making authority of each member or manager. It can talk about if you don't agree on something, how you go about the sell of the company. There's one where it just says you guys can bid, and whoever has the highest bid buys the company. So that way it's kind of like you don't want to go too low or you don't get it. And if you go too high, you understand. I think it's like a Texas shotgun wedding or something, whatever it's called. So when you have an operating agreement, it can help prevent misunderstandings because it's nice to set these expectations up before there's emotion. The higher the emotion, the more problems this could be. But if you start to address these beforehand, I know it takes being proactive and it might be a little bit tedious. Just an ounce of preparation will be pounds of prevention. So you could talk about who's responsible for day-to-day operations, because if you have partnerships, you might have all the great intentions and excitement. I know I've been in partnerships where I didn't want to worry about these things because it was only going to work out, but it didn't. And then it was more difficult by not having a good operating agreement. They'll talk about how decisions are made as far as voting, whether it's a majority, supermajority, or has to be consensus. You can talk about what happens if a member doesn't fulfill their obligations, right? You can tailor financial arrangements. You can have profit sharing that you outline or loss sharing percentages, which might not always align with ownership percentages. It can outline how and when distributions are made, including any priority payouts to certain members. And I'm telling you, this can really help avoid conflict by detailing how additional capital contributions will be handled. If you're going to have to put more money in the company and someone isn't going to put money in, will that change the ownership or the benefits? So this can really protect members' interests. The buyout terms, as I mentioned before, or it could specify what happens in the event of a member's death or divorce or bankruptcy. See, because when you're in a partnership, you get the assets of that partner as far as what they bring to the table, but there's also liabilities, life changes, health changes, a number of factors. If there's disputes among members, it can help you prevent unwanted third parties like spouses or creditors from acquiring an ownership interest, right? It can establish dispute resolution processes. Customized agreement can include everything from mediation or arbitration clauses that could avoid costly litigation, guidelines for resolving deadlocks and decision-making, and it can minimize internal conflicts by just providing, clear protocols. So yeah, that's a lot with an operating agreement, but this is where it's not just legalese, it's who are you, what do you want, and what do you want in a partnership. Now let's talk about the fourth issue. And this is the alter ego issue. The term alter ego means other self, right? So if we're talking about it legally, it's talking about a situation where the corporation is not treated as a separate entity, but instead is more like a mere extension of the owner or shareholders. It's really used to pierce the corporate veil. Plaintiffs will argue that the corporate entities, it's a sham and it's a separate existence should be disregarded to hold individuals personally liable. This can happen if, let's say you have a business credit card, but you're putting personal things on it, or you're just robbing your business to do personal lifestyle things that aren't even tax deductible. You're trying to make them tax deductible, but it could be a problem in court. All right, so alter ego is just don't abuse the business. Don't just take your personal money out of there. It's also a bad example for employees. Like we have the same protocols for employees and owners in our businesses. You have to get reimbursed. So I don't use business cards. I use personal credit cards and then reimburse for the things that were business expenses to never have this issue of alter ego. The fifth issue in incorporating is when you're incorporated, not having an annual meeting. This is part of your corporate compliance and also what could pierce the corporate veil by not doing this. Now, I like to have my annual meeting in really cool places. We've done it in Spain and we've done it in Italy. We've had these, Hawaii before, where we'll go to dinner and we'll have like, what are we talking about for the next year for the company, especially the companies that are my wife and I or just me and, maybe some of the key employees. We could do that or maybe have a cool retreat. But it could be a partial write-off on a trip that you're taking. If you don't do this, it will be problematic for your corporate veil if you ever sued. Now, let's get into the different types of corporations and where they might make sense and might not make sense. One of the issues I see is a lot of people are solo LLCs. Like an LLC, it's kind of the new kid on the block, came out in the late 70s, but now it's the most popular form of incorporation, a limited liability company. It's a pass-through entity, which means you can't retain earnings. And it's not really good for fundraising or if you're going to take the company public, although I don't really recommend most companies go public. It's, it's a little bit harder to differentiate income unless you use an S election. But if you're in a partnership, an LLC could be great because you could tax as a partnership. You could have one partner take more tax advantage than the other or a higher income than the other. It has ultimate flexibility. Now, you can use an S election if you're the only owner of that rather than go set up a new entity. But that's what a mistake is that people have an individual as an LLC versus in a partnership. All right, let's talk about C corporations. I'm going to a little bit more detail here because C corporations are a little bit onerous, and there's fewer of them in small business, but it could be really useful, especially if you plan on selling the business 5 years or later, because you can use Section 1202 and each partner can sell up to $10 million tax-free if it qualifies. A C corporation is really great for raising funds, right? If you're raising funds in other entities like an LLC or an S corp, it's a little bit more problematic. A C corporation is not a pass-through entity, so you can retain earnings. It offers other advantages too, making a kind of a good choice for certain types of businesses that are focused on raising capital or really trying to scale and grow. Here's some kind of other benefits of it. You have this unlimited growth potential. So ability to raise capital, you can issue multiple classes of stock, common and preferred stock. You can sell shares to an unlimited number of investors, including individuals, venture capitalists, institutional investors, even foreign entities. C Corps are really ideal for public companies because they can go public via an initial public offering, and that might bring in more significant investment opportunities if that's the right thing for you. C corporations have perpetual existence, meaning there's continuity beyond owners. A C corporation continues to exist even if the shareholders leave, sell their shares, or pass away. So it could be really an advantage for a legacy business. It can provide stability and longevity, which can be critical for building a lasting brand, for example. Now, let's talk about some of the tax advantages that could happen in a C Corp. You can deduct a broader range of business expenses, including salaries, bonuses, fringe benefits, and health insurance. You have a lower corporate tax rate. As of 2018, the corporate tax rate is a flat 21%. And that might be advantageous for businesses with significant retained earnings, right? You're not going to have to pay tax on that pass-through during that year. So C Corps can retain profits with the company for reinvestment without distributing them to shareholders, therefore deferring the taxation. Other benefits for employees can be attractive compensation packages, tax-deductible fringe benefits such as health insurance, retirement plans, stock options, even educational assistance. That way you can attract and retain top talent. Some of the tax-free benefits are shareholder employees can receive certain benefits tax-free, like health insurance and group term life insurance when it's structured properly. There is no ownership restrictions. They can have an unlimited number of shareholders, including foreign investors, as I mentioned before. So unlike S corporations, there aren't restrictions on who can own the shares, making C Corps ideal for international businesses or joint ventures. There is flexibility in ownership structure, multiple classes of stock. They can have, flexibility in ownership rights and preferences. For example, like a preferred stockholder can have priority in receiving dividends or liquidation proceeds. And there's also credibility with investors and lenders as a C Corp. I mean, the biggest companies really in the world are often C corporations. So C corporations inspire confidence in institutional investors, banks, and other financial institutions if you're securing financing. A lot of investors prefer C Corps due to their flexibility in ownership and ability to provide equity incentives. There is flexible financial management, like they can retain earnings to reinvest in the business without requiring immediate distribution to shareholders. They can pay dividends to reward shareholders or retain profits for strategic growth. And some other things to consider, though, is there is double taxation mitigation. See, C Corps face double taxation, corporate profits, and dividends. But there's tax strategies. You can pay higher salaries to shareholder employees. You can offer stock options. You retain earnings within the corporation. These are a couple ways that I've kind of mentioned that might reduce the tax burden. On the earlier dollars that businesses make, like I know businesses, we've had like dentists and chiropractors that they might have like separate businesses where they're selling supplements or something. They set up as a C Corp and it earns a lot less than their major corporation. And what it does is it actually has lower tax on the smaller proceeds. So that's an advantage over like an S Corp or an LLC for some people. So a C Corp can be, the shares can be bought, sold, or transferred super easily. So that's pretty attractive. And they're really suited for mergers, acquisitions, and selling the business outright. So just those are considerations as well. Also, with the C Corp, you can have an ESOP, an employee stock ownership plan. And you can establish an ESOP to give employees ownership stakes, improving morale potentially, retention potentially. Might be a good way if you don't want to sell your business to outside, but you want to retire in the business and still be part of it, but reward the people that work for you. So that's just a couple ideas with the C Corp. Okay, so we've talked about LLCs, great for flexibility, different, tax benefits or salaries or distributions. It's ultimately flexible, protecting you from the partner. Now let's talk about an S Corp. An S Corp is limited to 100 partners, but I wouldn't really recommend S Corps for partnerships because whatever the percentage is dictates what the distributions are. So the dividend rules are a lot more restrictive, which might not make sense. Now, as a cash cow, you're the only owner. You want to take as much income from this as possible. You could take a salary plus distributions and avoid self-employment tax, which could be really great because you're paying yourself a reasonable salary as the owner. But if you have employees and infrastructure, when that's helping you make money, you're getting distributions on that. And that could be as much as 15.3% savings or as little as 3.2, depending on how much income we're talking about. And once you kind of capped out the self-employment tax. All right. So that's not a lot that I said on the S Corp. I really spent a lot of time on the C Corp and even on the LLC. Now to something that I want to heed warning. I want you to really pay attention to this. Sometimes people partner when that's not required. I don't know if you ever heard the saying, the only ship meant to sink is a partnership. I've had some amazing partnerships and some brutal partnerships that were so exhausting and detrimental. I remember a long time ago I had a partner where I bought this business, and as soon as I bought it, he just went to Hawaii for several weeks, and then he went from Hawaii to culinary school, and he never came to the office, never met any employees, but he wanted 50%. Right? So you got to be careful. Like, how are you going to compensate if you're in a partnership? What are the roles? This is where the operating agreement is critical and essential. Could maybe it be handled through compensation, not partnership? Sometimes people give equity when it's not required. There's 5 types of compensation. One is salary. We know about that. But there's also bonuses as a team. If the whole team hits something, everybody gets a bonus. Individual bonuses for when they hit their objectives or goals. And then non-monetary bonuses. Something like an iPad like I have here, or, a trip that they really enjoy. And then there's also stock options. A lot of people think they want ownership, but what they want is upside potential. And they're more interested in upside potential, or when they contribute to the bottom line, getting a part of that, than ownership. Ownership means, hey, guess what? We're sued. Everybody's being sued in the company, right? The owners. Or, we need a capital call. All the owners are giving a capital call. So a lot of people, they just want to feel like they're part of something. They want to be able to benefit more than just trading time for money. So be careful not to give up partnership when it's not required, or giving up partnership and then not defining it. And so they start to filter and want partnership of other parts of your business that aren't included in this. So capital calls, liability, those are critical. Now, the last piece here is sometimes people choose the wrong state. Some states, they're not perpetual, especially in a trust, or some invite more taxation and even have less protection. So let's look at it. California, New York City, Illinois, New Jersey. These are less attractive places to incorporate because there's high taxes. They have high corporate income or franchise taxes, and that can make them less appealing for businesses focused on tax efficiency. If you think about those states, it's a lot of burdensome regulations, right? Complex labor laws, environmental and zoning laws, that increases compliance costs. There's expensive maintenance fees, higher annual filing fees, franchise taxes, and all types of reporting can cost and create strain on small businesses. So let's go through this again. If you don't incorporate in your business, that's problematic. If you're trying to do it on your own to save money, it might cost you in the long run, because having an attorney that specializes in this area is key. If you just have a general, generic boilerplate operating agreement, you're leaving yourself susceptible to problems when they arise. Think about those beforehand. If you commingle funds, or you use your business like to fund your lifestyle instead of having the right protocols and procedures that is treated like a true business, then you might have the alter ego issue where in court it wouldn't hold up and it pierce the corporate veil. If you're an LLC but you don't have partners, you're missing out on the protection against other partners, or taxing as a partnership. But in S Corp, well, you can take salary plus dividends, but it's inflexible when it's distributions to partners. So you have to choose the right one for you. I'm not an attorney. So what I'm doing here is planting seeds to get you to think, should I be an LLC, an S Corp, or a C Corp? Now, there's limited liability partnerships and family limited partnerships, and there's different entities. There's even B Corps for those that are really benefit corporations that might have big charitable interests and things like that. I'm not going into those details. I'm focused on the main 3. The key is to get an amazing attorney that specializes in this area and incorporating. Now, I made a mistake early on by having too many corporations. Every little thing I was doing. Every individual piece of real estate had an LLC, and every, business venture that could have just been a revenue agreement. If it's the wrong person, no contract will do. If it's the right person, no contract really matters, but we still want to do the right things. I once had an accountant say, hey, I think you should be an S Corp, but the attorney wanted to be an LLC, and they didn't communicate or coordinate, so it created a problem for a few years. You don't want an accountant either to tell you, oh, you don't need to incorporate. They're not attorneys. If they are an attorney, great, they can give that legal advice. Make sure that you have a professional, and don't get the person that just, if they think about you in the shower, they charge you. I've literally heard about attorneys that do that. You want the person that you know that you can meet with on a regular basis, that you know what you're paying for, and that you're not feeling like you're nickeled and dimed. I used to have this attorney that would show me how much he charged me for copies. I'm like, you gotta be shitting me. Why don't you just scan those in for free? Copies? Are you kidding me? Like I had to go through a bunch of my legal binders today because there are certain things for reporting that's now been updated in 2024. And so I was going through all that. And there's just so much paper, so many binders. Like, are they efficient enough in their world to just have it digitally available to you? That's also a nice thing. And a lot of times you can do a strategy with the attorney, and their paralegals can do the work to save you a lot of money on the implementation because there's a lot of busy work with this. So let's go to what would money Jesus do? I know. I do look like Jesus. I mention it so you aren't confused and distracted. Like, holy crap, he's back. But why did you pick now of all times? In Utah, did you know that people get paid to model as Jesus for family pictures? Yeah, read it in the Wall Street Journal. But I chose to do this instead. So what would money Jesus do? Incorporate. And really focus on a customized operating agreement. That's where it's worth the extra time. How do you want things handled? Whose roles and responsibilities? How does voting work? What if you're at a stalemate? What if someone doesn't do what they're supposed to do? What happens in the event of divorce or death? Really think those things through. If you're going to have retained earnings, consider a C corporation. If you're going to go public, consider a C corporation. If you're going to sell 5 years later, consider a C corporation for Section 1202. If you have a cash cow, consider an S corporation. Take salary plus dividends and avoid the self-employment tax. FICA for you to, up to 15.3% on those distributions. If you have a partner, consider an LLC. It's very flexible and you can protect yourself from their liabilities, and you can be, higher tax benefit for one versus the other, higher income for one versus the other. You guys get to choose. Look into Wyoming or Nevada for incorporation, maybe even South Dakota. Rather than partner, consider the 5 types of compensation. Can you handle it through salary, through bonuses, through non-monetary incentives like trips and technology? Is it stock options that they could get over time, and they could be non-voting or voting, and you get first right of refusal if they choose to leave, so you could buy those back? Consider the upside potential conversation first rather than just going into partnership. Maybe have a time period where you see how you work together, where it's a consulting type of arrangement, or it's based upon specific production. Consider getting a holding company. A holding company can actually own your interest of your other companies and flow up, so it's really easy from a tax perspective. I have an intellectual property company called Ripwater. It's published several of my books, including these 2 books, Killing Sacred Cows and What Would the Rockefellers Do? Ripwater Press. So it's an intellectual property company that, owns this equipment that I'm filming everything on here because it's a production company. So that company owns my interest of my consulting company, Wealth Labs. Wealth Labs, when people sit down with me and I do one-on-one consulting with them for a day to build out their financial team plan, overcome their money blocks, design their key 5 objectives that help them get on track in the next year, get their financial house in order, and create financial independence in a much shorter period of time, saving a boatload of tax, just to name a few of the things that I do. But Ripwater owns that interest. It also owns the interest in Garrett Gunderson, LLC. Garrett Gunderson LLC is the incubator when I'm starting a company and it's in the early stages. Or own some of my old intellectual property before Ripwater was created, which is my, intellectual property company. So consider a holding company, but hire a qualified attorney. Don't just get something off the internet or chat GPT. This is legal liability and tax ramifications. A good one will pay for themselves 10 times over. I have a corporate attorney and a tax attorney. They coordinate and work together, and they've saved me so much money in tax over time because of the type of corporation that we chose and what that will do for me now and in the future from classifying income. So some of the income has lowered the tax rate 15.3%. Another one went from 37% to 29% because we moved it to a S corp, so we could take the qualified business deduction. So don't hold back on this and get too chintzy. Get the right people. Make the attorney's jokes just like I did here. But here's the deal: keep more of the money that you make. Protect yourself from liability, and do the right things for your business now and in the future, and it's going to pay tenfold.